What's up traders, Tom here with another video. Today we have seen the last battle line drawn between the bulls and the bears. 3000 has been breached on the S&P 500. The 200 SMA has been hit and the market hasn't even opened yet. So what the hell is going on? Stay tuned. In this video, we are going to be covering my thoughts on why this is occurring, some concerns I have about the current economy, what is doing well and what is doing poorly, and my technical analysis thoughts on the indices, as well as some cross analysis with some different pairs to get an idea of what we might see in the future. I'd also like to remind everybody that if you've been enjoying our videos, please support the channel and make sure to subscribe and of course hit that bell and like the video if you're enjoying our content. So the question everybody's probably watching this video for is, how is the S&P 500 above 3,000 pre-market on a Tuesday morning? Well, the answer is big companies are doing way better than anyone expected. If you're taking a look at the actual Q1 financial earnings, 97% of the S&P 500 has now reported, and it looks like in terms of aggregated earnings estimates, they are beating estimates by 2.6%, while the Fed is pushing QE and all sorts of course, monetary policies and fiscal stimulus. We can also say, excluding financials, earnings are surpassing expectations by 7.1%, with 65% of companies exceeding their lowered projections. And these are important facts, no doubt. This is interesting because when we take a look at the other information, on May 12th, of course, Goldman Sachs cut its GDP forecast, and they warned that, of course, unemployment rate would spike to 25%. Other companies coming out and basically saying Q2 would fall by 40% rate. Then we've got Friday, JP Morgan cut their GDP for 2021. And then of course they said unemployment rate will stay above 10% through the end of the year. Look, I totally think all of these things are correct, but this is the disconnect between large companies and small companies and the real economy. And many people are arguing that, and it's totally fair enough. So effectively, if you were to look at the top 500 companies, there are some that are not doing well at all, and everybody would be well aware of that. But as a whole, the companies that are suffering the most are small companies, mum and dad, or I think you call them mum and pop shops, very small companies, and basically small businesses will suffer. And also, if you're looking at something like the Russell 2000, the smaller companies are doing very poorly because their cash flow and their ability to withstand this kind of effectively massive recession and cash flow cutoff is just not as strong as a company that has huge amount of borrowing power and huge amount of earnings. So companies are using this to probably lean up. And I think when you look at what happened during the GFC and you look at what happened during any crisis, especially now that we're being able to work online, companies will effectively fire staff and they won't bring them back. So we are going to see a disconnect between unemployment and company earnings. And the government's going to have to be very careful about how it treats this over the long term, because otherwise companies will be making bumper profits while the economy is really doing very, very poorly. So before we go into the next part, of course, many newspapers and information is claiming that the Dow was jumping 500 points on recovery hopes and vaccine news. Look, I think a lot of this might be true, but really vaccine news, yes, there's 20, 30, 40, probably more vaccines in production. Yes, they're going into phase 1 trials. It's kind of expected, but as we've done a video on, it takes longer than the stock market is probably even projecting to get a vaccine. And no one has ever successfully got a vaccine yet for one of these types of strains. So this is not, I think, a good enough reason for the market to be going up. I think it's more likely the Q1 beats are good enough. So this chart pretty much sums up the current issues that we have. We've got biotech and internet FDN all-time highs. Then we have banks, aerospace and defense breaking through key trend lines and actually selling off. So you can see the disconnect between certain industries, and this is because some are more susceptible to the current crisis and some are just doing an amazing job and absolutely doing amazingly off the Fed stimulus. So biotech and internet, no doubt they'll continue to do well. I think there still will be pullbacks, and pullbacks may create opportunity, but at the same time, it's clear that the days of the banks and the days of the old businesses that everybody has always known will not be as profitable probably as they ever have been before, due to what the Fed has done and how the money system is moving towards. Does anyone think here that you can get back to 6 or 7% interest rates again? I don't think so. I think it's impossible now. Everything is moving towards Japanification, if you want to call it. What Japan has done will become what every single economy that introduces quantitative easing will end up doing. And that is a never-ending supply of cash and QE and tapering. And we'll talk about tapering problems in this video. And that is pretty much the new norm for what we're going to see long term. Before we get into the technical analysis, the second wave, I think this is still the major concern for markets, yet the markets have not reacted to it. Remember, we are at a key point in the market, which we're going to be talking about. So Virginia opened around 17 days ago, and we have now seen 1,483 new cases, being the biggest single daily jump so far. And if you've looked at any of the media at the moment, there are some crazy parties with hundreds and hundreds of people going on. It's the same here in Australia. People are sick of it. Fatigue is worn in. People are sick of hearing about the virus. They're sick of everything. And effectively, all they're going to do, a lot of the young people say, it cannot hurt me, and they're ignoring it. And it is a problem long term. So it's quite unfortunate. But at the same time, I still think this is going to be the major story that will end up leading to a pullback in the markets. So let's take a look at our thoughts on the S&P 500. So firstly, psychological level 3,000 has been breached. 200 SMA has been hit. We've talked about this on the channel and how the 200 SMA acts as strong dynamic support and resistance for the market, especially on the daily. The other thing, Memorial Day weekend is just over, and usually over this next 2-week period, you see weakness in the market, at least over the last 2 crashes. So what's going to happen now? Well, look, you can't predict what is necessarily going to happen now, but if this level is breached, we probably touched 3,100, and then we would see usually a pullback back to the role reversal zone. So effectively the role reversal zone will be around this 2950, and we'll see the market come back, test this previous resistance and find that as support, and then it could bounce back up. It really depends on what the news ends up becoming. If the second wave is the concern, then I think we could go even further down, because there's real economic implications for that as well as business implications. If we don't see a second wave and we get a cure or something else happens, or the Fed comes in, and of course, as I've put in this thumbnail, Jerome Powell comes out, becomes Superman, and effectively saves the market again. Look, I don't see how we can't get above 3,400 again, and possibly even breach up to 4,000 over the next 12 to 18 months, while we still see unemployment at 15-20%, and that is because of the nature of the money in the system. Now, do I think the risk reward is there? Absolutely not. Would I be saying I'm going to buy 3,000 with all of my money and long hold it right now? Probably not. I might hold some, like 40 or 50%, but I'm not going to hold all of it in, because to me, I always think of everything as a risk reward. And is it worth the reward of maybe seeing 3,400, maybe seeing 4,000 in a theoretical world? Or is there more downside risk, in my opinion? And I still think there's still more downside risk than there is up. So in terms of answers there, it's more of a wait and let the price action tell you what's happening. If you see a breach below 2,800, I think the bears are back in. If you see a breach above the 3,100, there's a high chance we go at least 3,200 into 3,400 and hit the highs. So that's the kind of thing that you wanted to do. You look at everything from a statistical purpose and say, will this level reach, will this level not? So interestingly, I want to show a gold chart because I think gold is where a lot of people are looking to in terms of safe haven or hedge statistics. So here we've got a trend line, and this trend line was tested pre-market, and I'll say that again, pre-market today, where the price came down to 17.20 and then it has bulled up and it's sitting at around 17.29 right now. Now this trend line is pretty important because it is effectively supporting gold, and there's quite a lot of support and resistance through this zone of around 17.20. So it's interesting, all of this is happening pre-market open in the US. We've breached pre-market. We've seen gold come down and test support. We've seen currencies do very similar things, hitting key levels pre-market. So we haven't seen the US market open yet. We don't know what the money flow is going to do. And I wouldn't be buying anything until you see closes above zones, because you need to see the money flow actually at least agrees with you, and you'd want to see some damn good volume as well. So I always like to look at other correlating industries or correlating instruments before I make any decisions. Remember, we still said the other day, the Dow holds the key of the breach. So if we go to the Dow now and take a look, have we seen it above this resistance zone? Absolutely not yet. If it breaks it, well, sure, it makes sense for this range to be repeated. So we would take this range, we'd say this range is going to be repeated. Where does that take the market to? Straight into this 200 moving average, which turns out to be the previous support. And it doesn't matter which Dow chart you look at, this is going to be the same kind of concept. So that's my thoughts technically, but what about the Fed? So I'm going to use these two charts. Obviously, I could have got these ones to Fred, but for time reasons, I'm going to use this. And this particular Mish Talk website, they call it the suspended belts and suspenders. The main thing I want to talk about is really that this is what happened when they introduced QE policy. This is what happened when they tried to taper that policy, which we'll call the belt or the tightening area. They couldn't tighten it. They could not tighten it. They tried to, and they couldn't do it. And then we're at where we are now. We're basically breaching $7 trillion in terms of policy. Now, that is a huge amount of money, but you can see that they are unable to get rid of this problem. And Japan shows us the same problem constantly. If we have a look at the actual number in terms of what they were able to bring it back to, October 2017, 4.462 trillion. By August 2019, they got it to 3.77 trillion. And then even before this crisis, they were back to 4.169 trillion. It's insane. They cannot get out of this. So I think that really comes back to the investment types that you need to make. You need to recognize, is the stock market going to go up over time? It is, absolutely. And that's because of this kind of policy. Where is this money going to go? I've talked about on this channel before. We will not see 16 times earnings as the new norm anymore. We're going to see something crazy like 21 or 22 times earnings, purely because, and I firmly believe this, because of the amount of money in the system. So it's not possible for them to ever get back. They can't get back. They can never taper this. That's my opinion, but I don't think they can. If you disagree with me, let me know down below. They will never be able to taper this money off, in my opinion, without restarting the entire monetary system. So yes, they will never be able to get out of it. And yes, that means that at some point you're going to have to get into assets that benefit from this kind of cash coming into markets. I hope you enjoyed today's video. Try not to FOMO as much as possible. It's very tough right now, I understand. Hopefully not too many people are hard short and stuck with too many positions that are not doing well. But look, this is what happens during any market crash. You always see a huge pull up. We've talked about it. We've got some more great videos to come with some crazy stats. But at the same time, this is what happens, and they don't call it a bull trap for nothing. And they also don't call it a different type of crash every time. There's always something unique and special about these crashes, and we've never seen one with this much money into the economy. So if you're enjoying our videos, make sure to comment down below and let us know your opinion and give us feedback on how our videos are. Make sure to smash that like button and of course subscribe and hit the bell for more content on the financial markets. Happy trading, everyone. and we'll see you in the next video.